Good afternoon, ladies and gentlemen. Welcome to the 26th of August, a weekly market review. The key phrase over the weekend and today is the time has come. And I'd like to ask Gerald, the time has come. How is your weekend, Gerald?
Yes, indeed, the time has come for us to do the weekly market review once again. I think basically we have seen some comments from the Fed Chairman Jerome Powell last week, and that's led to some developments in the financial markets, and that's something that I want to be sharing with everyone today.
Yes, I think, Gerald, I will not waste any more time today and let you go ahead with your presentation.
Okay, thanks, Sunny. Before we start, the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, if you find our weekly market review helpful, do leave us a review on Google through this QR code. And to actually join SIAS as a member, you can go to this website, sias.org.sg/membership, or scan this QR code as well. As a SIAS member, you'll be able to access the various online resources as well as investor education programs. Okay, what did we see for the market last week? There was a rebound amongst the US stocks, such as the S&P 500 is now back to above the 5,600 level. And likewise for the STI, we saw a rebound as well, now back to the 3,380 level. So what is actually driving this bounce in the market? It is really around the greater confidence that the Fed will cut interest rates in September. Okay, we start with inflation data. This is for Singapore. Like what we have seen in the US, the consumer price index increase has actually moderated. And if you to look at the core CPI data for the month of July, it rose by just 2.5% compared to the previous year. So that is actually a further sign that inflation is easing, not just in US, but in Singapore as well. Okay, what we have seen is a moderation in US bond yields, together with the greater expectation of the Fed rate cut. This is the US one-year government bond yield. What we see here is that it is now down to the 4.4% level, which is effectively close to the lowest level in a year. After the moderation in inflation, as well as the investor confidence that the Fed will start to cut interest rates soon. Okay, and in terms of what we have seen in the investor expectations of rate cut, just as a recap, I put up this data just last night, and what we see is that there is still a very high probability that the Fed will cut interest rates in September, with 76% probability that it will be a 25 basis points or 0.25% rate cut, and 24% probability that it'll be a 0.5% or 50 basis points rate cut. Okay. And what we see here is that by December this year, investors are having the expectation that the interest rates will be 1 percentage point lower than where it is today. Moving on to the Singapore market, we saw the bounce in the STI last week. There were a number of stocks that did well, including SETS, which was up by more than 10%. It's a stock that I will go into more detail later. But we also see some of the REITs having a bounce, given the lower government bond yields. Okay, so Frasers Logistics and Commercial Trust up by 5%. CapitaLand Ascendas REIT up by 4.4%. Okay, in terms of the worst performers, we saw some profit taking in some of the names that have done well, including Yangzijiang Shipbuilding, Singtel, as well as ST Engineering. Okay, but not a significant fall, and these stocks are still significantly higher year to date. Okay, I wanted to start with a quick recap of the Singapore banks. It is a sector that we've seen a lot of investor interest in. So given that all of them have reported their first half results, this is a recap around what they've reported in the first half of this year. Okay, before we go into their second quarter and first half results, it is worth noting that the Singapore banks have all done well year to date. The Singapore banks have outperformed the Straits Times Index, with the STI up by with the DBS up by 17.5%, OCBC up by 10.8%, and UOB up by 6.8%. Okay, in terms of what was reported in the first half of this year, we saw that DBS was the one that saw a significant growth in their first half net profit compared to the previous year. Okay, OCBC also reported close to a 10% increase in its profit compared to the previous year, but for UOB, it actually came down slightly compared to the previous year. Okay, in terms of the loan growth for the Singapore banks, it was fairly mild. Okay, most of them just reported about 2% increase in your loan growth compared to the previous year in the second quarter of this year. So I think the slower economic environment has actually tempered the demand for loans. Okay, so not much increase in the loans that they have given out compared to the previous year. Okay, in terms of the net interest margin, it has stayed fairly resilient. Okay, particularly for DBS, where we see that the net interest margin in the second quarter of this year was at 2.14%, flat compared to the previous quarter and just slightly down compared to the previous year. We have seen a more significant decline in the net interest margin for UOB and OCBC. For UOB, it's come down to 2.05% from 2.12% in the previous year, and for OCBC to 2.2% from 2.26% in the previous year. What has helped the banks to be able to grow their profit is really a growth in their fee income, particularly from the wealth management business, where across the three banks, we have seen an increase in the asset under management of their wealth business. Okay, so given that the loan growth has been moderate, the net interest margin has been stable, if not coming down slightly, it is really this growth in their fee income that has helped to support the earnings for the Singapore banks. Okay, in terms of the non-performing loans, it has been fairly low as well. So given that the economic growth is still doing decent this year, we have not seen a significant increase in the non-performing loans for the Singapore bank. So this is nothing to be too worried about at this point in time. Okay, what a lot of shareholders will be happy to hear is that they've been able to grow their dividends. In the first half of this year, all three banks actually reported an increase in their dividend payout. For DBS, UOB, and OCBC, we saw an increase in the dividend per share in the first half of this year compared to the first half of 2023, as well as the second half of 2023. Okay, so at this point in time, the Singapore banks offer a dividend yield that is above 5%. DBS expected dividend is the highest at 6.4%, followed by OCBC at 6.3% and UOB at 5.9%. Okay, next I wanted to talk briefly about SIAS. We saw the very big bounce in the share price last week. Okay, so we saw that for the first quarter of this year, SIAS share price has been on a downward trend, but started to recover from April this year. From a low of about 240, it's effectively bounced now to 357 per share. And last week's gain was fairly sizable at more than 10%. Okay, so what did we see SIAS actually reporting for the first quarter of fiscal year 25, which is the quarter ending June? The company reported a profit of 65 million, which is a turnaround from the 30 million loss in the same period last year. Okay, we saw the revenue rising 15.5% compared to the previous year. The EBITDA went up, and likewise the operating profit also grew significantly. Okay, so across the board, a strong set of results reported by SIAS. Okay, across the different business segments, we saw a growth in the revenue. So earlier we mentioned that the revenue grew by 15.5%, and this is something that was seen across its cargo as well as ground handling businesses, and across its aviation and non-aviation related businesses. Okay. Across the regions, we see that the growth is something that has been seen across different markets. So Singapore grew by 18.7%. Outside of Singapore, the rest of Asia grew by 36%. And likewise in EMEA and Americas, we saw this growth in revenue for SIAS as well. So it's something that's very broad-based, which is supportive of the revenue growth across the group. Okay, what is driving this growth in revenue? We see an increase in the flights that were handled by SIAS, an increase in the cargo tonnage that was handled, as well as more meals served across both its aviation as well as non-aviation businesses. Okay, so the increase in the number of flights has actually helped SIAS, as well as the increase in the cargo business has also led to an increase in revenue for SIAS this quarter. Okay, with the improvement in profit as well as operating cash flow, we see an improvement in SIAS' financial position. Okay, the total debt came down slightly, but more significantly with the growth in its EBITDA, the net debt as a percentage of the EBITDA came down. So across the different balance sheet measures, we see an improvement for SIAS this quarter. Okay, in terms of the valuation for SIAS at this point in time, price to earnings of about 21 times, which is still below the historical average, and price to book of about 2.2 times, which is also still below the historical average. Okay, in terms of what to look out for this week, we have a very important earnings, which is NVIDIA's earnings. That's something that will drive the US tech stocks as well as the general S&P 500 index. For those of you who are looking at the Singapore savings bonds, it's close to the end of the month, so we have the closing date that is coming up on the 27th of August on Tuesday. Okay, with that, I'll hand over to Sunny, who will share with us the technical analysis.
Hey, thanks, Gerald, for that in-depth coverage on SIAS. I think SIAS is really reaping its reward from the acquisition of WFS in 2022. And in last year, 2023, the stock price was pretty in consolidation mode. And then now we have the big breakthrough now with the giant earnings that Gerald went through just now. So I also covered that in the technical insights video. If you like some perspective on the technical side of things and some of the entry levels that you can look at, you can refer to the technical insights video as well. And for today, going through the index on the technical perspective, I would like to start with the US first because last Friday at the Jackson Hole Symposium, Jerome Powell, the Fed chair, actually announced that the time has come for the rate cuts to happen. And the path is very clear, but the pace and size of the rate cuts will depend on incoming data. Pardon me if you hear that too often, okay? So we are looking at a 25 basis point cut in September, and how much more going towards the end of the year, that would require us to follow the data closely as well. So let me touch on the Dow Jones Index first. So as you can see, after last Friday, Jay Powell's speech, the index of the Dow Jones actually rose about 1.14% or 460 points. So we are now about just 200 points away from the all-time high that we see in July. And that is around the 41,376 points. So some of the key earnings coming up this week could actually propel some of the major US indices towards a new all-time high, which is one of the chit-chat topics that I had with Gerald before the start of the show. Okay. So what should investors be looking at for the Dow Jones Index? Firstly, the indicator-wise, you can see the MACD is looking very positive. In the past 5 or 6 trading sessions, it has been showing a positive reading. So the uptrend is very much intact and has a bit of momentum going on as well. The RSI is concurring what the MACD is saying with the reading at 63. It still has some room to go up before it hits the 70-point mark of the overbought level. And I just like to take note, when we hit the all-time high somewhere in July, the RSI reading went up to the 83 points reading. So there's still a lot of upside for the RSI to go before hitting some kind of a overbought conditions in the RSI indicator. So investors who are looking at the Dow Jones Index, you should be quite happy right now. And we are now anticipating a new all-time high from the Dow Jones Index. Next, let me move to the S&P 500, which also performed quite well on last week, the whole of last week. So we had a 1.15% gain last Friday. That's up 63 points. And we are now about 35 points away from the all-time high in July, and that's at 5,669 points. So a 30-point movement in the S&P 500 is pretty common. So I would say it's now within striking distance or touching distance of the all-time high already. With the big earnings of Nvidia coming out Wednesday, that is not a problem at all. Okay, so on the indicator wise, although we see that there's some kind of a subsiding momentum in the MACD indicator, but you can see from the last 7 trading sessions, most of it have been positive, and that decline in the momentum is just slightly. I believe part of it on Thursday, we do see some kind of pullback on some of the major indices. That is due to some of the risk-off sentiments that we are seeing, because just before Jackson Hole, they don't want any surprises. So Thursday, we see a risk-off kind of a reading, and then Friday, you see that green bar again on the candlestick. That means it's risk on back after Jerome Powell's speech. So this is how I would take what the MACD histogram bar in the last 2 trading sessions is telling me. On the RSI, we still have a 61-point reading. So it's a very healthy reading, 10 points below the 70-point mark overbought level. So we still have room to push higher with the healthy momentum reading on the RSI. And the all-time high reading of the RSI is at 81. So there's still room to grow for the S&P 500 to power upwards as well. Okay. Lastly, let's move to the tech-heavy Nasdaq Composite Index. So Nasdaq Composite Index still has some way to go before it starts to challenge its all-time high in July. The all-time high is at 18,671 points. We are now at 17,800 points. So we are about 800 points away from the all-time high that we are seeing. Okay, so last Friday, the Nasdaq Composite Index rose 258 points or 1.47%. And it is also a good indication that the Nasdaq Composite investors or tech-heavy investors are also taking more risk now since last Friday Jackson Hole Symposium by the speech from Fed Chair. So the MACD reading is positive, although you can see that there's a lot of risk-off kind of a sentiment happening. There's a lot of profit taking on the Thursday session, but then it still has a positive reading on the MACD indicator as well. So we are seeing like 17 consecutive winning session or positive reading session from the MACD indicator. The RSI at 57 is the weakest reading among the 3 major US indices, but nonetheless, it is still above the 50-point neutral mark, which means that there is positive momentum in the Nasdaq Composite Index, and there's a lot of room for it to go before it touches the 70-point mark, which is the overbought level, which will indicate a pullback. And the high that we saw on the RSI or near the all-time high in July period hit the 80-point level as well. So there should be a lot of room for the Nasdaq Composite Index to power upwards if, let's say, we get a positive earnings from the Nvidia results on the coming Wednesday. Okay. Lastly, let's move back to the STI index. So STI index mostly carried by the banks. The 3 local banks carry a big proportion of weightage on the STI index. So thank you, Gerald, for covering the banks earlier on. So with the interest likely to come down, okay, some of the net interest income of the bank might be affected, but as you can see from Gerald's presentation just now, the fee income of the business is also doing very well. So I believe the impact will be limited, and thereby STI would also have a upside to look at, especially when interest rate starts to come down. It is seen as a new dawn for property counters, as well as a lot of you likes to live into the REIT sector as well, and that could have a positive impact on the STI index as well. Okay, so on the indicators reading of the STI index, we can see that in the past 5 trading sessions, there has been a positive reading already. So that means that the trajectory of the STI index is up right now. And then a crossover happened somewhere last week on 19th of August of the MACD line above the signal line. So that's the confirmation. And we are now pending if the MACD line, the signal line cross above the zero baseline in the MACD indicator. That means that the upside momentum will be exponentially be expanded to push the STI higher and probably retest the all-time high at 3,509 points as well. So the RSI latest reading is at 56 points, and that is 6 points above the 50-point neutral mark. So that is a positive reading, indicating positive momentum. And we still have some way to go before we hit the 70-point overbought mark. And the high that we saw in July, the reading actually hit the 78-point level. So a lot of upside that STI could catch up on to retake the all-time high. And this positive indication from the indicators is telling us that the momentum is still up right now, and the uptrend that we see since the beginning of August should continue towards the end of the month. Okay, so these are my takes on the indices this week. Any last word, Gerald?
Yeah, so quite a number of developments in the market after we have seen inflation coming down, comments by Fed Chairman Jerome Powell. I think everyone's eyes are now on the upcoming Federal Reserve meeting in September. But before that, we have got the NVIDIA results this week that a lot of US stock investors will definitely be looking very closely at. And those are things that we hope to be able to update you again at next week's weekly market review.
Yes, I do not have a crystal ball, but I think I can foresee Gerald will be covering some part of the NVIDIA result on next weekly market review, which is coming up next Monday. So I do not know for sure, but we'll look forward to that. And with that, I'd like to thank everyone for your time today in tuning into our weekly market review. And we'll see you same time, same place on the weekly market review next week. Goodbye.